Good morning all and welcome to Seraphim Space Investment Trust's full year results webinar. I will shortly hand over to the Chief Executive Officer, Mark Boggett, Chair of SSIT, Will Whitehorn, and Chief Investment Officer, James Brugger, to run through the results presentation. As a reminder, there will be a Q&A session at the end of the presentation. If you would like to ask a question, please submit the question using the Q&A Zoom format. I will now pass on to Mark, Will, and James to begin the presentation.
Good morning, everybody. Welcome to our results presentation after our first year as a public company. Seraphim Space Investment Trust really genuinely is a unique vehicle. It is the world's only listed investment trust focused on space tech. And space tech is at a real inflection point. We are going through an industrial revolution in space at the moment. We can see that quite clearly just by looking at the number of satellites launched in the past 2 years. There's been one of those hockey sticks that you so rarely see, but people predict is going to happen. Well, this one is really happening. And the reason for that is many. It's partly due to the cost of space launch coming down so much. It's partly due to the miniaturization of technologies. It's partly due to the development of artificial intelligence. And all of these things have allowed satellites to do a far greater range of tasks than was ever possible before. So not only is it supply-led from the point of view of what satellites can do, but in addition to that, it's also demand-led. It's led by the demand for much more detailed knowledge of what's happening on the planet's surface from a range of organizations, governments, and indeed commercial entities. The low cost of launch has allowed these satellites to be launched in much larger numbers. So we get low Earth orbit constellations. And those allow us to monitor the climate. They allow us to monitor the oceans. They allow us to monitor very, very exact things. For example, one of the companies we've invested in is currently talking to the British government about being able to tell them which precise houses throughout the UK have got the least energy efficiency, so that they can write to those people and offer them the kind of grants that are available. That's the precision that we now have. We're down to centimeters and millimeters of precision for everything from heat transfer to, for example, CFCs. We can now tell if a chimney in Vietnam is producing CFCs when it's not allowed to. And that is something that's not been possible before. In addition to that, the other driver has been defense. In the past year, the Ukraine situation and Russia's invasion of Ukraine that followed the events that preceded it have led to an increased demand from governments for the kind of information and knowledge that is available from the satellites that are now circling the Earth. Many of the companies are companies that Seraphim Space Investment Trust has invested in. And that's driven the value of the companies because they're getting real income, often ahead of their budgets and planning. And the portfolio's strong revenue growth has also resulted in an increase in the net asset value of this trust of 1.9% in the year to the 30th of June, at a time when many other NAVs and other investment trusts have been falling. So welcome to Seraphim Space Investment Trust and welcome to the team. I'm going to start with Mark Boggett, who's going to tell you about progress over the last year.
Thank you, Will. So it's been an intense period of activity since our IPO in July of last year, where we raised 150 million capital, including cash and share issuance. So we believe that we've executed well on the investment strategy articulated at the time of the IPO. We've focused predominantly on growth. We've focused on the highest caliber, highest profile companies in the sector. We've doubled down on companies where we've got the most conviction. And we continue to see a high quality early stage deal flow, particularly from our affiliated accelerator activities. However, in relation to performance, there's been a stark contrast between our public listed companies and the private element of our portfolio. Public holdings have been hit hard with the risk off macro environment as many tech stocks have been sold off worldwide. We've got 3 listed portfolio companies. We have strong belief in their underlying fundamentals of their companies going forwards. So for example, Spire Global has been reporting 133% year-on-year growth. Its recurring revenues are up to $85 million per annum, and yet the share price has been particularly weak. So contrast that to our private holdings, which are largely performing well. There's positive growth metrics, and they're benefiting from secular tailwinds, increased budgets for climate change and global security, as Will has outlined. The companies are generally well funded, where just a couple of material holdings are requiring funding before summer of next year. So given the prevailing macroeconomic market conditions, we think that the performance of our portfolio, and by extension the fund, has been robust. Portfolio value, 104.3% of cost at the 30th of June, and NAV per share up 1.9% to £1. So let me start with the highlights for the year to the 30th of June 2022. On the 31st of March, the share price was at £1.05, a small premium, and that's fallen to 53 pence on the 30th of June, a massive 47% discount to the £1 NAV per share. Market capitalisation was down at 127 million, down from 251 million in the last quarter. The portfolio is valued at 186 million, with net assets of 250 million, including cash of 57.7 million. The trust doesn't have any specific benchmarks, but as it can be seen in the charts, the performance is aligned to a rebased FTSE All-Share and NASDAQ sterling adjusted for the period since IPO. So strong premium since IPO gave ground during 2022 as global stock markets sold off growth stocks. And as the charts show, the SSIT share price was aligned with NASDAQ and the FTSE All-Share until April 2022. Since May, the trust has diverged materially. We've included benchmarks for the MSCI World Aerospace and Defence Index and for the MSCI World Climate Indices to demonstrate the performance of these sectors. We consider them to be very relevant, given that 94% of the revenues that are coming from our top 10 private companies are from defence and climate-related customers. So this slide is the attribution analysis, which provides an analysis of the movement of the value of the investments. So I'll explain this chart from left to right. So 28.4 million aggregate cost of the initial portfolio acquired at IPO. 150 million is the aggregate cost of the additional investments, including the retained assets and the follow-on investments completed during the period. The negative 9.2 million is the fair value fall, reducing fair value to 104% of costs, which is 98 pence excluding FX gains. So the principal detractors were the listed portfolio. Arkit was down by 18 million, Spire down by 1.5 million, AST by 1.3 million. These are all the listed holdings. Deorbit was down by 6.2 million, and that's principally as a result of falls in the prices of comparable listed companies that are used in calculating its fair value. We also have the markdown of two private portfolio companies, Astroscale and EduBees, down by 2.4 million collectively due to underperformance relative to expectations. So partially offsetting these downward evaluations, we have a number of increases, including Altitude Angel. They increased by 5.3 million due to the achievement of a range of technical milestones. And then Planet Watchers increased by 4.9 million, reflecting the price of a round that closed after the end of the period. FX gain has been positive, 16.8 million. And that's because 21 of the company's 26 holdings are denominated in currencies other than sterling. So foreign exchange valuations accounted for 16.8 million, and that contributed positively to NAV. And this is principally as a result of sterling weakening against the dollar over the period. As a consequence, the fair value of the portfolio reached 186 million at the end of the period versus 187.6 at the end of March. So this next slide is a review of the NAV bridge. So again, let me talk you through this in some detail. So NAV increased from the 175 million at the beginning of the period to 239 million at the end of the period. This increase of 64.3 million was primarily as a result of the additional 61 million of shares that were issued to acquire the 4 retained assets. 7.7 million of portfolio fair value increase, which includes FX movements. And then in this other category, that breaks down to 2.7 million of management fees and 1.4 million of operating expenses. And they were partially offset by interest of 0.1 million that was received. At the end of the period, the trust had 57.7 million in cash reserves and liquid assets. Now that's 24% of NAV. And we've got a further contingency of a further 18.6 million, which is based on the value of the listing holdings that we've got the ability to recycle if required. So it's in this context that it's worth spelling out that the portfolio companies are well capitalized. We expect to use the majority of this remaining cash largely to support the existing portfolio companies, but most of the companies are already well funded through into the second half of next year. So this next slide sets out the key investment themes for the trust. Climate and sustainability is our core focus, covering areas such as weather prediction, extreme weather event evaluation and support. So that's flooding, wildfires, hurricanes, and humanitarian support. Then there's agriculture, food security, carbon monitoring. So key portfolio companies there include Hawkeye 360 and ICEYE. Next is global security. So this is an area that's focused on things like secure communications, intelligence, surveillance, reconnaissance, and navigation. Now, let me be absolutely clear. We don't invest in weaponry or anything that's offensive or designed to hurt humanity. Key portfolio companies there are amongst the names that I've already mentioned, the likes of ICEYE and Hawkeye. These companies have dual use. Finally, an area of focus is space sustainability. So these businesses are focused on monitoring debris, removing debris in space, and providing services to satellites to extend their economic life. The overall focus is on the enablement of the commercialization of space, because there's hundreds of thousands of satellites that are being launched, and we need to be able to carefully monitor, operate these satellites safely and in harmony. So this next table shows the intensive investment activity during the course of the last year. So the 5 biggest investments at the top of the table accounted for 69% of the total 150 million invested. We invested and led a range of rounds. So we led in Hawkeye, ICEYE, Allspace, Satellite View, and Zona. And we were also involved with actually setting the price of the Astroscale transaction. So there were 6 investments from this group that were drawn from the Seraphim-led accelerators. So they act as a feeder to the trust. And on the right-hand side, you can see that I've identified through color coding yellow, green, and gray boxes, show how that these companies are serving customers across defense, climate, and space services. You can see that, that defense and global security are often the first customers, the cornerstone customers, with a heightened focus on global defense due to activities in relation to the outset of war in Ukraine. We've seen growing defense budgets around the world, reaching record levels not seen since the Cold War. So this has been a core driver of commercial activity during 2022. And sadly, we see growth in these defense budgets as a long-term trend that's going to continue to underpin the portfolio in the years ahead. So this next slide looks at highlights for the last year. And what I've focused upon here is the revenue performance of the private portfolio. So they represent 23 of the 26 portfolio companies. The charts there show the revenue and booking performance of the top 10 companies, 9 of which are private. So NAV weighted average revenues were up by 52% over the year. And then bookings, which are a forward-looking measure of value, were up by 71%. Now, these private companies are really well capitalized. They've raised more than $700 million during the course of the year. And that's versus the $380 million that's been invested into our 3 listed portfolio companies. So that's more than $1 billion that have been invested during the course of the last year into our portfolio companies. So as a consequence, most of the portfolio has cash resources to see them into the second half of next year on average, and some into many years. There's a couple of exceptions to that are raising rounds currently. But the trust has 57.7 million of cash at the end of the period. That's 24% of our NAV. And we've been making a number of investments since the end of the period, and we still hold 48.8 million today, post those additional post-period investments. So those are the highlights. Then let's look at the lowlights for the period. So the lowlights for the period relate to the public part of the portfolio. 3 companies which saw their values drop by 55% in aggregate. Now, last year was a record year with 16 space tech businesses going public by the 30th of June, raising collectively 7 billion in capital. But like most companies that have gone public via mergers with special purpose acquisition companies, or SPACs, the space businesses have seen their share prices hit badly in the wake of worsening macroeconomic conditions. In fact, given the relative unique characteristics of SPACs, such as warrant overhangs, limited free floats, and heavy shorting from hedge funds, I'm pleased to report that we've not seen the share price performance and valuations manifesting themselves in the private finance markets. Investors recognise that these SPACs have some special considerations. So the performance of the space tech SPACs in the trust's portfolio are actually not a reflection of their underlying commercial performance, which has actually been relatively robust. I mentioned earlier that Spire Global have grown their revenues by 133%. They've got an annual recurring revenues of $85 million. Arkit, which is one of our larger holdings that's now valued at 51% of fair value versus cost, has likewise reported strong figures during the course of the year. In their first year of revenue, doing 12 million of income. So they're on track for their full year. And then AST has also performed positively during the course of the year, launching the world's largest satellite into low Earth orbit. This is the first of their cell towers in space that are going to be able to provide communication to any mobile phone. So we stand by these portfolio companies, and we believe that the fundamentals will come through in due course. The other company that's worth mentioning here is our portfolio company, Deorbit, because they announced on the 27th of January 2022 that it was going to go through a SPAC process with a company called Breeze Holding. Now, that transaction was announced on the 12th of August, that we'd reached mutual consent with the SPAC to end that relationship. So despite not consummating the SPAC, Deorbit has continued to perform very strongly. They've completed an additional 4 missions for their space taxi business. So they've now completed 6 in total. They've transported more than 80 satellites into orbit. So they've also achieved a whole range of world firsts. So this track record is very favorable compared with other listed companies in that launch market. So we believe that Deorbit continues to perform robustly. So this next slide looks at the private investment into the space tech domain. So Seraphim releases a quarterly publication called the Seraphim Space Index, which shines a light on the trends of private investment into the sector. So the chart on the left-hand side there is an index, which is indexed back to Q1 in 2018. And what you can see is the continued sustainable growth in terms of the amount of investment and the number of deal volume that's been supported during the course of 2021 and 2022. The chart on the right-hand side shows the annual amount of investment flows in the global space domain. And you can see the red line there. That's the year-to-date 2022 figures, which you can see are closely correlated to the 21 figures, which itself was a record year. So we're seeing zero reduction in investor appetite. And in the year to the 30th of June, there's $12.2 billion invested privately into the space tech market. So this next slide looks at the portfolio, focused upon the top 10 companies. But before we get into that, let's look at the donuts on the left-hand side that paint a picture of the portfolio. So first of all, you can look at the stage of investments with Soonicorns. So these are businesses that we believe will become unicorns within the next 3 years. They represent 66% of the overall value. Now we can compare that to 10% for the listed portfolio. In terms of investments across the ecosystem, data represents over half, 55%. So these are businesses that are building the satellite constellations. They're building this digital infrastructure in the sky. In terms of geography, this is broadly spread, with the US accounting for 26%, UK for 36%, and the EU for 32%. And then finally, revenues. So this chart is focused on the private companies in the top 10 companies, and it shows that defense and climate account for 94% of revenues. So next of all, to turn to the net asset table on the right-hand side, the top 10 companies accounted for 67.6% of the total NAV. So the private portfolio, which comprises the main part of the company's investments, represented 90% of fair value. Now these all performed well, with their fair value closing at 122% of cost. That's 117% if you exclude FX gains. So Arcit is the only public listed company in the top 10, and they fell from a valuation of 27 million at cost to 14 million of cost. And this is largely reflecting the performance of the broader SPAC market. So excluding FX gains during the period, 7 of the main portfolio companies saw increases in their fair value. So across these 7 companies, the fair value weighted average increase was 146%. So of these 3 companies, Zona, Satellite View, and Allspace, they all saw fair value increases as a result of closing new funding rounds. So these companies on average saw a 220% increase in the value of those rounds that were closed, with a range of other investors participating at arm's length. 2 portfolio companies, Deorbit and Altitude Angel, saw their valuations increase as a result of achieving material, technical, and commercial milestones. And they increased on aggregate by 108%. And then PlanetWatch is also saw an increase to its valuation because they closed the funding round just outside of the end of the period. That round's now closed, but we discounted that to be conservative by 15%. Now, invariably, there's also been some disappointments in this private portfolio, with 4 companies that have been marked down during the course of the year. So their average holding period is now, their holding value is 72% of cost. So in 2 instances, and that's Astroscale and EduBees, fair values fell due to the application of a discount to the price of the last round. So in the case of Astroscale, this was due to a setback of achieving a commercial milestone on its latest satellite servicing demonstration mission. In the case of EduBees, the markdown was applied due to a material underperformance relative to expectations. However, in both cases, we remain optimistic about the long-term prospects of these businesses. Now, fair value was written down to nil for the holdings of 2 early-stage companies, equivalent to 1.9 million in total, both of which were seed-stage companies that were actually part of the initial portfolio. So during the period, we took the difficult decision not to participate in the investment rounds of these companies, as both had failed to execute against key commercial and technology-related milestones. So these write-offs are modest, but they illustrate our disciplined approach to investment and a timely reminder that not all of the companies that we invest into will succeed. But it's worth noting, of course, that we continue to invest in companies, and those that we continue to support, we're expecting them to deliver substantial returns over the longer return that will more than offset disappointments along the way. So the next slides look at transactions in the last quarter. So we've remained really active throughout the year as we continue to benefit from a high quality deal flow. However, we've reduced the size of the tickets that we're investing into most new investments, given the unclear timetable for being able to seek to raise additional new capital into the trust. So this slide gives an overview of investment activity in the most recent quarter to the 30th of June. So during this quarter, we completed 5 transactions, 3 new investments and 2 follow-on investments, deploying 7.7 million. So the 2 investments were into Zoner. So Zoner is focused around GPS. So many billions of devices worldwide already use GPS for navigation. And this is really set to increase dramatically as autonomous vehicles and autonomous systems come to the market. So Zoner's GPS constellation, we believe, is going to have high demand from the defense community, who will use it for resilience in case their own GPS constellations are attacked. But also from the commercial domain, where every autonomous system, it wants Zoner's capabilities around centimeter accuracy, precision, and enhanced levels of security. So we believe that the addressable market for the Zoner opportunity is measured in the tens of billions over the longer term. And Zoner is the leading private company in this market. So next of all, a new investment into the portfolio, Tomorrow.io. So they're focused on weather disruption, where inaccurate weather forecasts are impacting every sector. So Tomorrow.io's customers receive hyper-local weather information. That means what's going to happen in their area over the next 1 to 5 hours. So that is then paired with operational decision-making, such as staff rotas and consumer communications. So this business provides its services to customers through an enterprise SaaS platform that's then powered by AI analytics. And it's also currently developing its own satellite constellation of radar and microwave-based satellites to expand its own data sources and enhance its products' capabilities. So we've continued to remain busy and our cadence of investment. I'm not going to dwell too long on this slide, but post-period, we've continued to make investments. Our view very much is that the history demonstrates that some of the best return investments are made at the bottom of an economic cycle. So we continue to be active. We've done 7 transactions during the last quarter, with 3 new investments and a total of 8.9 million to deployed. We'll go into this a lot more when we report next quarter, but Voyager is an exciting business that we've invested into. Uniquely, they have a buy and build strategy where they're acquiring companies in the space market. They've already generating more than 100 million in revenues, and they're working alongside Lockheed Martin as one of 4 consortium parties that have secured funding from NASA to build commercial space stations. So Taranis are very front and central to our climate related focus. They're using AI-powered agriculture analytics to provide sub-millimeter analysis down to the individual leaf of plants to identify signs of disease, pestilence, lack of water, etc. So this helps improve crop yields, and the company's playing a key role and a key theme focused around food security. And then finally, a follow-on investment into Planet Watchers. They provide global scale information to the crop insurance industry, providing with information around acreage reporting, crop classification, planting dates, and importantly, details on the damage due to flood and wind events. So during the periods, along with assistance from an external agency called Sancroft, we published our own ESG policy. So we've developed a ESG due diligence tool, and we've further developed our investment process to ensure consistent considerations of material ESG factors are embedded into our investment process. So there are 3 elements to our approach. ESG integration. So this is the explicit inclusion of the E, S, and G factors into our financial analysis. It's a core part of deal origination, due diligence, and the investment process. Exclusionary screening is a key element of our process. Space tech is inherently dual use. So we have a sophisticated tool in place that helps us determine the use cases for these technologies, the customers that may use them, and the countries in which they operate. So we specifically use that when we focused around companies that have defense-related applications. And then finally, and perhaps most importantly, all of the Seraphim portfolio is impactful. What we want to do is we want to measure the impact that our portfolio companies are making on the planet Earth. So what we use is the United Nations 17 Sustainability Development Goals as a framework to help us define and measure and report the impacts and positive impacts of the portfolio companies annually. So over a period of time, we're going to be able to quantify the global impacts of the companies that we back. So myself and the management team are particularly excited about our leadership in this role. So this is the final slide. So to summarize the outlook, we've had a period of intense activity since the IPO in July 2021. And we think that that's validated our model and strengthens our status as the leading specialist space tech investor globally. So our position at the epicenter of this new space global ecosystem continues to generate large, high quality investment opportunities from seed stage right the way through to pre-IPO and growth rounds. We also expect our listed position to help us expand into foreign territories. So during the course of this year, we've expanded into the US market with our affiliated accelerator activities. We've opened a new US subsidiary. We actually trade under the name Generation Space in the US market. So we believe that the Seraphim company portfolio is well placed to develop whatever macroeconomic challenges lie ahead. Although the challenges posed by supply chain issues, inflation, rising interest rates are not to be underestimated, most of our portfolio companies are well capitalized. There's $1 billion being invested into our companies during the course of the last 12 months. Furthermore, with the secular trends relating to global security, food security, climate change and sustainability, we expect these areas to accelerate. We anticipate that the demand for the products and services that are offered by the SSIT portfolio companies, and that's particularly from governments, will continue to grow. And this should result in the portfolio delivering strong return growth metrics over the longer term. So the company has a reasonable amount of cash reserves, nearly £60 million as at the 30th of June. And we believe that this is sufficient to provide the necessary levels of support to the portfolio over the course of the next year or two, to make the point that most of the companies are already well financed. So we also have a further 18.6 million of liquidity available through the holdings of our listed companies if we wanted to access that. So today, the cash holding is 48.8 million. We expect to continue to diversify the portfolio with small selective new investments, given the uncertainty around the timing of the market recovery and therefore our ability to be able to raise new capital. That means that the size of the new investments that we're likely to make are going to be considerably smaller than on average in the past. But we think it's really important that we continue with the pace of investment and the opportunity that's presented by investing at this stage in the economic cycle. But it's clear, and I want to make this clear, that the balance of investment activity is going to be more weighted towards supporting the existing portfolio, where we believe that the focus of our activity should be.